Hello everybody, this is Gabriel. Just wanted to provide you some insights into the futures systems I trade. And they're all trend following systems and they all rest upon two important components, which is a hook and support and resistance in several time frames. So let's start with a practical example here. That's the S&P future on the weekly chart. We're in an overall uptrend and the pattern has just formed. Let's start with the hook. So the hook is this price activity we see here. A hook is composed of a test bar, a strong test bar, and then price activity that shows a rebreak of the test bar higher. So this is war going on between the bears and the bulls. And whenever a test bar is broken higher, well, that's the first confirmation that the bulls are actually winning the war. I never want to enter into a trade like before the war occurs or during the war. I actually want to wait for confirmation who is the winner who comes out of the war. Now, all three systems are based on a trap, and this hook activity is actually a trap. It's a double trap. So counter trend traders who came in here into the markets, they are trapped into a bad trade because we are overall in an uptrend, and some, let's say, long-term investors have already been long for quite some time, so that they might have been trapped out of a good trade with this strong activity against them. So this is a double trap, and double traps are particularly strong to base a low-risk trading idea upon. So what is the low-risk trading idea here? Well, entry is with the rebreak of the green line, and the stop is placed at the breakout failure low. Well, the stop is very well protected. Why is that? Well, it's not only on the other side of this horizontal green line, it's as well on the other side of the 21 moving average. This price activity has been tested, this line, and it as well on the other side of the black and the gray moving averages, the 5 and 8. This was another test of the bears to push prices lower, and we see a clear rejection here of this level of the 5 and even the 8 moving average. So with the stop at the breakout failure low, the stop is as well on the other side of a very strong support 21, and it's on the other side of a very strong support of 8. So let's talk about this second component. I already talked a little bit about it. Let's support and resistance. So there's static support and resistance and dynamic. With static, I mean with static support and resistance are you can identify a clear price label, which is this green line. So it's a horizontal line, and it's formed by these swing touches that this pattern, that this activity of this pattern actually makes. So this pattern rests upon this base. We see some very clear and precise swing touches. Dynamic support and resistance, here I'm looking at the higher time frames. So one higher time frame is the monthly and two time frames higher is the quarterly chart. And dynamic support and resistance are the moving averages. We can clearly see here how they are respected. So the 8 is respected very well. With some deeper pullbacks, the 21 is respected, and we can clearly see how these are tests of price activity, or you can as well say that the bears have tested to go lower and they actually failed. We see something very similar here. We see a very strong test of the 21 and it seems to fail. We see a very strong test of the 8 and it seems to fail with this very big bottom wick. So these are all edges that are added up, which makes this actually a really good low risk trading idea. Now you might say, well, is it really a low risk trading idea? The stop is huge. Well, you have to see this or analyze this in perspective, right? So what would be the target? Well, the target is always the swing move, the measured swing move, and it's up here at the 4,000 price level. So with this stop, you get about a 4 to 5 reward to risk ratio. So this is still a great low risk idea, right? Can you only trade these systems and these patterns in the higher time frames? No, not at all. I've got a strong belief that markets are fractal, so these patterns, they occur in any time frame as well. They're very low time frames, like the 15-minute chart, the 5-minute chart, the 1-minute chart, or the 15-second chart, or even lower. So this upprice move is something I call a snapback move after the price has been really overextended from the moving averages. And this snapback move here on the weekly chart was tradable, or there were patterns of this system in lower time frames, like the 1-minute chart. The mid frame and the high frame of these lower time frames, they get aligned fairly quickly into a new uptrend. And this snapback move was able to be traded in these lower time frames on similar patterns like this. So a general advice is to wait for the war to end, and only then enter with signs of strength. And do not let yourself to be trapped out of a good trade or trapped into a bad trade, trying to counter trend against overall trend direction. So I hope that was of interest.